Hello, my name's Kelly Lemon. I'm here for Property Investor News at the Excel Centre in London. We're lucky enough to be joined by Stephen Johnson of Shawbrook Banks. Stephen, thank you. So many S's there, Stephen. I didn't almost get them all out. Thank you very much for joining us today.
Pleasure.
So tell us a bit about you and your company and what it is you're offering to attendees at the moment here at Excel.
Yeah, so Shawbrook's one of the kind of newer specialist banks. We've been going for 7 or 8 years, and we've been very active in supporting professional landlords, portfolio landlords. I run the property finance business, which is a balance sheet of around 2.6, 2.7 billion. So we're pretty active. And at the show here, obviously talking to landlords about the issues that are emerging in the market. Obviously a lot of change going on with how lenders support landlords and the rules that they have to adhere to. And we're probably facing into kind of a rising interest rate environment as well. So just talking to landlords about all the things that are happening really, as well as trying to provide solutions, to customers as they're looking for financing. But so hopefully we can give them a bit of insight to the market.
And what sort of trends are you seeing in the market at the moment?
I think there's the trends that I think have been there for a little while persist. So the continual shift towards limited company type structures remains, obviously for the reasons around the tax changes, but also the underwriting approach of lenders. So there's still a difference now between limited companies and individuals. So that limited company shift is still there. We're probably seeing also sort of a more of a shift to sort of fixed rates, longer term fixed rates, for kind of a combination of reasons. I guess as landlords probably believe we're getting towards that point where rates are going to start to rise. It's been 10 years since they have, but it's probably ever nearer. And also, in terms of their ability to borrow money and so forth, longer term fixes can offer landlords opportunity to sort of borrow slightly more money than on shorter term variable deals. So that's the theme. I think, I'm trying to think what other sort of themes we've seen really. And then I guess the third theme that's pretty evident is probably a slightly different shift in geography. It's been quite noticeable for us that landlords are adapting to the changing environment by searching for higher yields, and that normally means them shifting towards multi-unit properties, but also looking at other regions in the country that offer higher yields. Now that brings with it other risks, but they're probably the three themes that I think are most obvious to us.
And obviously last year when we were at the centre, you spoke about the changes and how landlords really need to adapt and look at their cash flow. Do you think that message is getting through yet? Are you seeing that filter through your end?
Yeah, I'm not sure that we are. I think I have a belief that until the tax changes bite them in terms of the actual payment dates for the tax, and that those returns will start to be calculated, I still believe people probably don't really appreciate quite the impact. And I think that's further compounded by my age-old sort of clarion call that rates are going to go up, and they are on the brink of going up, I believe. So I still feel that landlords won't really appreciate it until they see it hit them in the pocket, and therefore we need to keep sort of promoting that message. And I think generally for landlords going forward, the reality is their costs are going to go up. Now that's because interest rates are going up, that's because tax relief changes are going to impact them, that's because licensing standards and other standards are going to increase their costs. So overall their costs are just going to all in one way, and therefore they just need to know what that does to their cash flow in terms of free cash, because it's going to be tighter. So I think we need to keep making sure that message is coming across.
And do you still think it's an attractive market to enter?
Yeah, I do. I think it just needs to be entered into and looked at through the lens of the modern market, and it is very different. Buy-to-let has had, and investors have had, a golden period because interest rates have fallen and rents have really accelerated. So they've had a very helpful environment, and the reality is that's changed, and therefore their costs are higher, their ultimate profitability is lower, but the opportunities in buy-to-let are still compelling. The shift to private rented is going to happen. The housing tenure in the UK is going to continue to shift towards more private rented property. It's still a levered investment, so you can borrow money to invest in the asset class, and you can hopefully appreciate long term from rising property prices. So all of those things are still hold, The only thing that's different is on the way through, the net income and the income available to landlords is going to look very different. And therefore they just need to make their strategies and their decisions with that reality in mind. And I think that's the thing that's the important takeaway. So as long as they're planning and thinking about it, realizing that their costs are going up, and therefore choosing how much they borrow in that context, then I think that's the important thing for them to decide on and be alive to when they're making their decisions.
You've looked at landlords, but looking a bit further afield in terms of the market itself, with Brexit and all those sorts of things, what other risk factors do you see on the horizon?
I think you talk about the housing in the UK, and I think everyone talks about it like a national problem. It's not a national problem. It's a problem for London and the southeast predominantly, where the supply and demand is completely out of hit, and you've got acute affordability issues. So I think I worry when people talk about we're going to put rents up, and that's going to cover all my increasing costs, because there comes a point when tenants can't afford the rents, and it's not a landlord's only decision. You know, they can't impose that on the market. The market will actually regulate itself in terms of what people can afford. So I worry about this kind of belief in landlords that rents are just going to keep going up and up and up. And actually, if you look in London now, rents are not going up for the first time. So, and London sort of leads the rest of the region. So I think we're getting towards an affordability cap on rents. So that's with Brexit. Okay, people could say, look, we're going to start to lose some of that appeal. We're going to lose some of the immigration. We're going to lose some of the employment. Yes, but overall, we're still going to see a growing population, and that population is still going to predominantly want to work and live in London and the southeast. So it's very much that part, I think, of the market that's got its own where most of the risks are, and I just think people need to be careful about what's realistic with rent levels.
And what advice would you give to those that are looking to enter the property market now?
I think actually, if you're going to enter it now, it's actually quite a good time to enter, because the playing field's all changed, and I think a lot of landlords that have been in the market for a long time will actually find they've got legacy issues from their portfolio, because they would have borrowed money to a level which, as tax changes impact them, is uneconomic. So they've got issues to resolve. They've got to figure out how they resolve those. Do they have to sell some property? Do they have to change their strategies? And everything's different for landlords now about how to borrow. And therefore, if you're coming into it fresh now, you actually can do that knowing the environment, knowing that the tax is changing, knowing that lenders are going to look at you differently if you've got 4 or more mortgage properties. And therefore, actually, I think the key message is, before you start, just try to understand the universe and the market. And then I think you can build your strategy with the new realities, whereas a lot of landlords are going to be focused and preoccupied with sorting out issues from their past.
You mentioned landlords, and you mentioned interest rates that you think may go up shortly. How much of an impact do you think that will have? Because we've had a few years now of landlords really having to look at what they've got and manage that. So do you think that the community is quite ready for those sorts of changes, or do you think there's still quite a lot of exposure?
No, not yet. I think it's been 10 years nearest damn it, so I think until it happens, people get used to sort of the benefits of the low interest rate environment. I think what you're starting to see is fixed rates starting to rise now. I think in the whole mortgage market generally, the rates have just been coming down, and for the first time, I think that trend's now changed and it's bottomed. So landlords will see higher fixed rates, and given that longer term fixes are becoming more popular, I think that's quite significant. And I'm not convinced people have really thought about the future in terms of what their tax costs might be. And then when you think, well, actually, what's my tax cost and my cost overall when interest rates are 2%, not 25 basis points? I don't believe people have done the maths, and they probably should. They should do that to make sure they understand how they would be affected in that environment. Because I think rates will go up gradually, but they're gonna get back towards a 2 or 3% level. I mean, that's what most people predict will be the new normal level for interest rates, and that's obviously quite different to next to nothing, which is what they are today.
And do you have anything else you'd like to add? Anything that you'd like to sort of kind of get out there to the wider community?
Yeah, I think the only other thing I would come back to is what I said at the outset, that I think it's quite evident that you're seeing landlords start to invest in areas of the country which they may not know that much about. I think because they'll be attracted by yield, as they can't raise the funding they used to because of the coverage and the affordability tests. High yielding properties will become more popular. And then I just worry that, do the landlords really know those areas? Have you got savvy investors selling in the local markets where they really understand? So probably selling their poorer stock to unknowing investors who think they're buying a good property. So I just think the only thing I would raise is that geographic and regional shift, and just making sure that if you do go down that road, that you do your due diligence and your homework, and you kind of, you know what you're buying, really, I guess. That would just be something I'd call out.
Stephen, thank you for your time and thank you for your input, as ever. We really appreciate seeing you, and it's good to see you back at the Excel Centre. This is an interview for Property Investor News, and we'll see you soon. Thank you for watching.